Welcome to Blue Nile Tutorials. In today's session, we're diving into our 7th chapter, Income from Employment Sundry Topics. Employment income can include a variety of lesser-known benefits and payments, and understanding their tax treatment is just as important. We'll explore topics such as taxable allowances, one-off payments, and other miscellaneous benefits that may apply to employees. You'll learn how these are taxed, when exemptions might apply, and how they fit into your overall tax calculation. So, grab your notepad and let's simplify these sundry topics in employment taxation. Let's get started. Welcome to this video on income from employment sundry topics. This final employment income related session is a summary of some sundry topics to be aware of. We've spent a lot of time looking at how to calculate the specific employment figures for a particular employee for the tax year, but now we will look at the overall employment system a little bit more. Employers are given a lot of responsibility in terms of dealing with the tax position of their employees. HMRC requires employers to use a system called real-time information to send details to them every time an employee is paid, whether this be weekly, fortnightly, monthly, or any other regularity. The report is made electronically and keeps HMRC informed as to who's been paid what, along with the deductions the employer has made for tax and national insurance. There are two key advantages to this real-time reporting. HMRC has information about what deductions the employer has taken from the employees and is therefore due to pay on to them, so that they can chase this money if it's not paid over when due. And HMRC have information about the earnings of any given individual so that this information can be used by other government offices, which may be useful in many situations such as when paying benefits, for example. Just going back to my comment on deductions, that's another responsibility for an employer. Before paying an employee for the work done, the employer is required to deduct income tax and employees' national insurance from the payment, which they then pay on to HMRC on behalf of the employee. The employee does not normally have to do much in relation to their tax affairs, as this is done at source for them by their employer. This leads us to consider another point. How does the employer know how much to deduct from the employee's wages? National insurance is fairly easily calculated and is not affected by other income that the employee may have from elsewhere, but income tax is much more complex. The income from all sources is accumulated for tax purposes, and the employer will not always know about what the other income is that the employee has. To deal with this, employers use pay-as-you-earn codes for each employee, sometimes issued by HMRC, but sometimes just general codes which apply in simple circumstances. A typical pay-as-you-earn code is calculated by taking personal allowance for the year, allowable expenses expected to be paid in the year, taxable benefits estimated for the year, but could also include adjustments for earlier year's tax underpayments. Most codes end with the letter L, but if the taxable benefits are greater than the personal allowance and expenses, it will instead start with a K. So if we were to look at a quote for 2018-19 for an individual with estimated benefits for the year of £8,000, the code would be calculated as personal allowance of £11,850, less benefits of £8,000, leaving £3,850. The last figure is removed, so this would become 385L. What if the estimated benefits were 12,000? Then the personal allowance of 11,850 less the benefits of 12,000 would leave £150 negative. Again, the last figure is removed, but because it's a negative, this would become K15. As reporting to HMRC must be made electronically, most employers now use software to calculate the wages for their employees, completing the complex calculations for them, producing payslips and submitting the information as necessary. One final administrative point is to be aware of some of the employment-related forms which employers produce, such as the P60. which is produced at the end of each tax year to show the employee their gross earnings for the year and how much tax and national insurance has been deducted. Employers are required to give each employee a copy of this form by the 31st of May following the tax year. The P11D, produced at the end of the tax year to show the value of benefits provided to the employee. Employers are required to give a copy of this form to the employee by the 6th of July after the tax year if any benefits were provided. Alternatively, the employer could apply to HMRC to tax the benefits being provided to the employee via the pay-as-you-earn system instead of reporting them on the P11D. This is known as paid rolling of benefits. The employee therefore will pay tax on the benefits during the tax year and doesn't then have to report them on their tax return. The employer therefore would not need to include the benefit on a P11D. The P45 is produced when an employee ceases to be employed for whatever reason. This is a summary of their earnings and tax deducted to date for the tax year in which the employment ends and provides the necessary information for the new employer. So this leaves us with one final responsibility of employers, which is slightly different to the administrative responsibilities discussed so far. HMRC place the burden on employers of deciding whether an individual who's undertaking work for them should be considered an employee or not. This may sound simple, but in some cases it can be quite complex. If an individual is working at the employer's premises for a set number of hours each week, using employer-owned assets and working in teams with other employees, it seems fairly clear that the individual should be considered an employee and therefore falls within the RTI system for reporting. But what if that individual claims to be self-employed, i.e. they submit an invoice every week or month for the hours they've worked and request payment in full without any deduction of tax or national insurance? Well, HMRC would require the employer to assess whether that person really is self-employed or whether in fact the invoice should be ignored, and they should be treated as an employee looking at the facts of the case. There have been many cases in the past where taxpayers, employers, HMRC have disagreed on this, as it's not always easy to determine. The outcomes of those cases is that there are 7 factors to take into account to make the decision which you should learn. Conditions of pay, integral position, risk, control, legal rights, equipment, substitute. These could possibly be memorized with the help of the mnemonic circles. Without spending too long discussing each, what we're trying to assess is whether the overall terms look like a business relationship rather than an employment one. So let's think about it in terms of some typical situations. Let's consider Debbie first. So she works a minimum of 20 hours a week, but often has more work to do than can be completed in that time. Her employer pays her for any extra hours worked. She is entitled to use a staff canteen free of charge and to take 4 weeks holiday a year. During the month of June, Ed worked for the same company and worked between 30 and 40 hours a week. However, Ed was set a specific task to be completed by him personally before the end of June for an agreed price. He worked different times each day and different days each week depending on what work he was doing elsewhere. Ed provided his own tools and equipment for the project. The terms of Debbie's work look like a typical employment situation despite her working variable hours each week. But looking at Ed, his position's not quite so clear. Working through the circles mnemonic. Conditions of pay. Ed is being paid a fixed fee for the project rather than an hourly rate. Integral position. Ed doesn't appear to be working with anyone. Risk. Financially, if Ed takes longer than expected to complete the work, he'll suffer the loss of income, so there's some risk. Control. Certainly suggests self-employment as Ed is setting his own hours and workflow. Legal rights. Ed doesn't appear to be entitled to holiday or sick pay like an employee would. Equipment. Ed brings his own tools with him rather than them being supplied to him. And substitute. The contract requires the work to be done by Ed personally. Some of these factors would seem to suggest that Ed is an employee, whilst others suggest self-employment. HMRC would take a view based on the overall position with no one factor being more important than any other. In this case, it's likely Ed would be considered self-employed, but this should make it clear how difficult it is for an employer to comply with this responsibility.